Welcome. Today's lesson is on corporate recording. So we take a quick look at the Eiffel Tower to start with. So I guess this lesson comes to you from Paris. How about that? Looks nice out there today. And we're going to take a quick look at exercise 1118 on page 499. And I'm just going to explain a little bit to you. This is part of the stockholders' equity section of the balance sheet as of a certain day. Okay. And let's take a look at this. Just a couple of things I wanted to tell you. I've copied over the little whatever we have here. I just wanted to go through how we put this together. So if you'll notice, when we have corporate recording, we list the type of stock we're trying to explain or tell about or talk about here. We have some common stock, and we list the par value and the number of shares authorized, and it says 30,000 shares issued and outstanding. So if we take 30,000 shares times $25, we get this $750,000 worth of common stock at par. Okay? All right, and that's what we do. So the common stock, the amount across from that is the number of shares outstanding times the par value. So $25 times 30,000 shares. The next line shows the additional money we receive for that. So we got more than $25 per share. Well, how much more? Well, let's see. How much did we get? If we got add the 750 and the 50,000, so we have $800,000. And that was for 30,000 shares. So it looks as though we got $26.67 on average. Okay. So any additional monies we received, so $26.67 less our par value. Let's see what that difference is. Looks like $1.67 per share. If we multiply that times 30,000 shares on average, it should give us our additional paid-in capital. So that would be $1.67 times 30,000, roughly $50,000. So that's how we get the 50,000. So the 50,000 is equal to the number of shares issued, authorized, and outstanding, which means we haven't bought them back yet, times the difference between the selling price and the par value. All right. So let's see. If we would have sold them all at once, why don't I just make a journal entry for that? So it looks as though if we sold these all at once, and that's what we got, we would debit cash, because we always get money for this, for $800,000, and we would credit common stock for the number of shares times the par value. All right. And finally, we'd credit additional paid-in capital for common stock for the 50 grand. So that's how that original journal entry would have looked. Okay, had we sold them all at once. So looking at this, the paid-in capital would represent the common stock, the paid-in capital amount, so $800,000. And if there was preferred stock and preferred paid-in capital, we would add that as well. Okay. I did want to take one quick look at the question again, so just got to go through that. If we purchased 3,000 shares of our own stock at $75 per share, we could record that as well. So that would be, what would that be? We would debit treasury stock, and that represents stock that we had originally sold but we bought back, and that was for, how much was it again? 3,000 shares at $25. Okay, so we list the treasury stock at cost. And then we have cash. We're going to credit cash for the amount of money that we paid for it. So this is pretty much how stock and treasury stock work. when we pay a dividend, and we're going to, I think, pay a dividend later on here, just looking at a couple. Oh, we declared a dividend, $1.50 per share, and there's usually 3 dates with the dividend: the date it's declared, the date it's payable, and the date it gets paid. Okay, so $1.50 per share. So how many shares are outstanding? Well, we used to have 30,000 shares, but then we brought 3,000 back, so there's only 27,000 shares outstanding. Okay, what we're going to do is debit retained earnings for the amount of the dividend, which is 27,000 shares times, I think it was $1.50, wasn't it? So it looks like $40,500, and we're going to credit dividend payable, because we haven't paid it yet, $40,500. Okay, and later on February 28th, when we pay the dividend, we're going to debit dividend payable for the $40,500, and we're going to credit cash $40,500. Okay, let's see if there's another one. I think oh yeah, we sold 1,200 of the treasury shares at $30 cash per share. Okay, we bought them back at $25, so that's the cost we're going to be listing our treasury shares at. So let's see how this would work. So we sold them at, oops, let's go down a little bit. We sold them at 30, so we're going to get cash for the shares we sell. Incidentally, the corporations don't pay income tax when they buy and sell their own shares at a profit, or they could lose money just as well. How many shares was it? 1,200 at $30 a share is what we sold it for, so we get $36,000. And we're going to reduce our treasury shares for the 1,200 we sold, but we've got them listed at $25, right? So we're going to take them out at the same price we put them in. Looks like $30,000, and the additional money is going to go to additional paid in capital for treasury stock. So that is going to be basically the $5 per share times 12,000 shares, so $6,000. Okay. So that's a little bit on how we report and how we track and list the transactions for corporate reporting. Thanks.